Budgeting is a fundamental part of running a successful business. Once you have established a revenue budget, your next step is to budget your expenses. A well-planned expense budget helps ensure that your business remains profitable, maintains healthy cash flow, and allocates resources efficiently. Your expense budget should support your revenue-generating activities while maintaining operational efficiency. The goal is to create a sustainable framework that allows for growth while controlling costs. Creating an effective expense budget involves analyzing historical data, understanding cost behavior, adjusting for future conditions, and aligning expenses with revenue projections. The following step-by-step approach ensures an accurate, data-driven budget that accounts for expected business activity and external influences. Start by collecting detailed records of past expenses. This includes reviewing accounting reports, bank statements, invoices, and payroll records. Organizing expenses by category will help identify spending patterns and create a reliable baseline for budgeting. Once historical expenses are gathered, categorize each cost based on how it behaves. Is it fixed, variable, or a mix of both? For variable and mixed expenses, determine the main business activity that drives the cost, such as units sold or customers served. Then determine the relationship between the cost and the driver. Historical expenses provide a baseline, but various internal and external factors will impact future costs. Before finalizing the budget, adjust for things like inflation or supplier changes. If the business is growing, introducing new products, or entering new markets, new costs must be factored into the budget. Now that historical data, cost drivers, and future adjustments have been analyzed, the next step is to calculate the final budget for each expense item. Once all expenses are budgeted, sum them up and subtract from projected revenue to calculate your budgeted net income. For advanced planning, it's useful to budget expenses for multiple revenue scenarios. The first step is gathering your historical expense data, which will serve as the baseline for your future projections. Collect data from sources such as accounting software, expense tracking apps, bank and credit card statements, supplier invoices and vendor contracts, payroll records, and tax filings. Having at least 12 months of historical data is critical, but 3 years of data can provide deeper insights into cost trends and seasonality. Business expenses generally fall into two main categories, fixed or variable. But there are some other types to consider. Fixed expenses are not affected by the level of business activity. Some remain constant from month to month, like rent. Others, like maintenance expenses, may fluctuate from period to period, but are not directly related to the level of business activity. Some common fixed costs include rent or mortgage payments, salaries of full-time employees, insurance premiums, and software subscriptions. Whether or not a cost is fixed depends on the time horizon you are looking at. Rent may be fixed in the near term, but if you continue to grow, you may need to add space in the future. Variable expenses fluctuate depending on sales volume or other business activities. These include the cost of goods sold, direct labor, sales commissions, shipping, and delivery costs. Semi-variable expenses, also known as mixed costs, have both a fixed and a variable component. For example, a restaurant may schedule a consistent level of staffing each day for pre-opening prep work, but then adjust the staff schedules for the rest of the day, depending on customer traffic. Their hourly labor expense would be a mixed cost. One-time or periodic expenses are non-recurring or infrequent costs that still need to be planned for, such as equipment purchases, scheduled maintenance, or legal fees. A step cost is an expense that remains fixed over a certain range of activity, but then jumps to a higher level once that range is exceeded. Machinery can handle production up to a certain capacity. If production is increased above its limit, an additional piece of machinery will need to be added. Likewise, office space can handle a certain headcount. If a company's staffing level grows beyond its current footprint, it must add new space or relocate to a larger space. By classifying and understanding costs, you can make more informed financial decisions. The ability to predict how costs will change under different scenarios is invaluable for budgeting, pricing, and strategic planning. Effective budgeting requires you to align expenses with their cost drivers. Some costs are determined as a percentage of revenue, and others are driven by different factors, such as the number of units sold, units produced, or customers served. Some businesses use a percentage of revenue to budget all variable or mixed expenses because of its simplicity. But misapplying percentage-based budgeting to all expenses can lead to inaccurate forecasts and poor decisions. Use percentage-based budgeting only for expenses that truly scale with revenue, such as credit card fees or sales commissions. Budget other variable costs based on their actual cost drivers. The cost of goods sold is driven by the number of units sold. Raw materials are driven by manufacturing volume. Packaging and shipping is driven by the number of orders shipped. Customer support staff is driven by the number of customers served. Where appropriate, you should break down your variable expenses into a rate and a unit component. Instead of looking at hourly labor per customer in dollars, look at labor hours per customer, and then multiply by your average wage rate to determine your final expense budget. This allows for more detailed adjustments and a better understanding of variances. If you spend more in labor than you budgeted, is it because you served more customers than expected, or because you used more hours per customer, or because your average wage went up? A more detailed budget provides more detailed answers. Cost behavior analysis is a critical component of financial management that examines how costs respond to changes in business activity. Understanding these patterns enables better decision-making, more accurate forecasting, and improved cost control measures. In some instances, the connection between a cost and an activity is straightforward. For example, if you sell your product exclusively through direct sales and pay each sales agent a 10% commission, your commission expense will be 10% of your revenue. However, in many cases, this relationship is less obvious and requires analysis based on historical data. We will explore two statistical tools for analyzing the relationship between costs and their drivers: scatter plots and regression analysis. These tools are widely accessible and extremely valuable once you understand how to use them. We will demonstrate these techniques using Microsoft Excel, but similar analyses can also be conducted using Google Sheets or various statistical software programs. A scatter plot graph is a powerful tool for visualizing the relationship between a cost and its driver. By plotting historical data, businesses can identify cost trends, determine if a variable or mixed expense follows a predictable pattern, and calculate a cost formula for budgeting purposes. This section will walk through the step-by-step process of creating a scatter plot in Excel, how to add a trend line and formula, and how to identify and address outliers that may skew results. Before creating a scatter plot, gather your historical data for the cost you want to analyze, as well as the activity that drives that cost. In our example, we will examine how labor hours are influenced by the number of transactions in a service business. By understanding labor hours, we can better budget for labor costs. Open Excel and enter the data into two columns, with the cost driver in the first column and the cost in the next. Highlight both columns, including headers. Click on Insert, then Charts, then Scatter Chart. Choose the basic chart with no lines. Excel will generate a scatter plot where the x-axis represents the cost driver and the y-axis represents the cost. You will immediately begin to see how closely these variables are related by the tightness of the pattern in the chart. To better understand the relationship between the cost and its driver, add a trend line and display the cost equation. A trend line is a line that goes through the middle of all of the data points and makes the relationship between the variables clear. Click on any data point in the scatter plot. Right-click and select Add Trend Line. In the Format Trend Line panel, choose Linear, since most business costs follow a linear relationship. Scroll down and check the box for Display Equation on Chart. Also check Display R-squared value on chart. The equation can be repositioned and resized to improve readability if necessary. The slope indicates that labor hours increase by 3.26 for each additional transaction. The intercept signifies the fixed component of the cost, meaning that even with no transactions, there is still a base labor requirement of 2,368 hours. The R-squared value shows the strength of the relationship between the two variables. The closer the R-squared is to 1, the stronger the relationship between the cost and the driver. Since the relationship is not perfect, you should expect some variance when using this equation to forecast your labor hours. However, actual results are equally likely to be higher or lower than the forecast. The variances should balance out over several periods. While forecasting is rarely perfect, this provides your best estimate. When examining your data on the chart, you may notice outliers. Outliers are data points that significantly deviate from the overall trend. These can distort the trend line and lead to inaccurate cost predictions. Look for points that are far from the trend line compared to the other data. Investigate the cause of each outlier and decide whether to exclude or adjust the data. If the outlier resulted from a one-time event, it can be disregarded for budgeting purposes. If it reflects an ongoing change, modify future projections accordingly. Regression analysis is another powerful statistical tool that quantifies the relationship between costs and their drivers. In fact, the trend line on a scatter plot is determined by a regression analysis performed behind the scenes. While visualizing data with a scatter plot can offer valuable insights, there are some limitations to consider. Most notably, a scatter plot only allows you to examine one driver of the cost you are analyzing. However, there may be multiple factors that impact the same cost. A multiple regression analysis enables you to take into account more than one independent variable simultaneously. In our example, we will use multiple regression analysis for a scenario where labor is used to produce two different products. Before performing regression analysis in Excel for the first time, you must enable the Analysis Tool Pack. This is an add-in that is included with Excel and which contains the regression tool. Open Excel and go to the File menu. Click Options and then select Add-ins. In the Manage drop-down menu at the bottom of the window, select Excel Add-ins and click Go. Check the box for Analysis Tool Pack and click OK. Once activated, the Data Analysis tool will appear under the Data tab. In our example, a factory produces product A and product B, both of which require labor hours. The company wants to determine how many labor hours are needed based on the production levels of both products. First, enter your historical data into Excel. In column A, enter the number of units of product A. In column B, enter the number of units of product B. In column C, enter the number of labor hours used to produce these units. To open the Data Analysis tool, click Data, then Data Analysis. Select Regression and click OK. For the input Y range, select the labor hours in column C. For the input X range, select both independent variables in columns A and B. Check labels if headers are included. Select New Worksheet to display results separately. Click OK to run the regression. There is a lot of information in the regression output. We will focus on a few key numbers. When performing a simple regression with one independent variable, like the scatter plot, the R-squared value tells us about the strength of the relationship. However, the adjusted R-squared is the more meaningful number when performing a multiple regression. Look at the coefficients column to determine your forecast equation. The intercept coefficient is the fixed component that does not change with activity. The A units and B units coefficients tell us how many labor hours are needed to produce each product. So the formula for forecasting labor hours in your budget is 63 plus 0.48 times the number of A units to be produced plus 0.34 times the number of B units to be produced. Using scatter plots and regression analysis helps businesses allocate costs based on true cost behavior. It provides data-driven insights into how expenses respond to changes in business activity. Historical expenses provide a valuable baseline for budgeting, but they must be adjusted to reflect future conditions. Internal business decisions and external market forces can impact costs, requiring businesses to modify expense projections to maintain financial accuracy. Ignoring these adjustments could lead to unexpected budget shortfalls, cost overruns, or missed opportunities. Internal changes come from within the business and often reflect growth, operational improvements, or shifts in strategy. Depending on their nature, these changes may increase, decrease, or stabilize costs. If you are opening a new location, you may need to budget for additional rent, utilities, staff salaries, and inventory. If you are launching a new product line, expect higher production and marketing costs. If you are implementing automation, expect lower labor costs, but higher software expenses. If you are switching suppliers, anticipate potential cost savings or new shipping fees. If you find a way to reduce waste or optimize processes, adjust for lower costs. External factors are outside the business's control but can significantly impact expenses. Businesses must stay proactive and adjust budgets accordingly. Due to inflation, raw materials, utilities, and labor costs tend to rise over time. Vendors and suppliers may increase prices, impacting operational expenses. Fuel price changes can affect shipping and transportation costs. Are contracts up for renewal? New terms may lead to higher or lower costs. Does your lease include automatic rent increases? Are you switching to a different supplier? There may be new pricing structures or additional shipping fees. Are long-term discounts expiring? Costs may increase unless renegotiated. Adjust expense projections based on any expected changes once all of the internal and external factors are identified. Review historical expenses to see which categories are most affected. Flag items impacted by inflation, supplier changes, or internal growth. Adjust fixed costs based on expected increases or decreases. Modify variable and mixed costs based on future activity. Update payroll and staffing budgets to factor in wage increases, new hires, and benefit cost changes. Increase affected costs for inflation. Adjusting historical expenses for future conditions ensures that budgets remain realistic and aligned with actual business needs. Now, let's bring everything together. To continue with our example of creating a labor budget, we will start with a production forecast for products A and B that resulted from the revenue planning phase. We can forecast our future labor hour needs using the projection formula from our multiple regression analysis. Total hours equals 63.15 fixed hours plus 0.48 hours per product A and 0.34 hours per product B. We do not expect any operational changes, so this provides our best estimate for future labor hours. Our current hourly wage is $22. However, due to inflation, we expect to raise wages by 3% in June. Therefore, we will adjust our formula to account for this cost increase. Multiplying our labor hour forecast by the appropriate wage rate completes our labor budget. Budgeting for future business expenses is critical in ensuring financial stability, maximizing profitability, and supporting long-term growth. A well-structured budget allows businesses to allocate resources wisely, control costs, and adapt to financial changes without jeopardizing operations. Thank you for joining us in this exploration of expense budgeting. Please like this video and subscribe to our channel to receive notifications about future videos.